The most expensive myth in trading that overbought means sell. It doesn't. RSI is the momentum signal in the Confluence method, and used correctly it's an early warning system. Used like the textbook says, it's a fast way to short strong stocks and lose. Let me show you the difference. RSI measures the speed and size of recent moves on a 0 to 100 scale. Above 70 is labeled overbought, below 30 oversold. But notice what it really tracks: momentum, not direction. A high reading means buyers have been aggressive, which in a trend is strength, not a reason to fade. The real edge is divergence. When price grinds out a higher high, but RSI makes a lower high, momentum is draining even as price rises. That disagreement is your early warning. It often shows up before price structure breaks, giving the swing trader time to tighten stops or prepare for a reversal. Here's the trap one more time because it matters. In a strong trend, RSI can pin above 70 for weeks while price keeps climbing. Shorting the first overbought print fights the trend and bleeds your account. In a trend, you use pullbacks toward the middle, not the extreme, as your signal. On real price, RSI is at its best as confirmation, not a standalone trigger. When it agrees with your structure and a key level, momentum rising into a breakout or diverging at a top, it stacks into a real edge. One indicator alone is a guess. RSI inside the Confluence stack is a signal. Here's how a swing trader actually uses RSI to time an entry. The trend is up. Price pulls back and RSI cools toward 40, not oversold, just resting. The trade triggers when RSI turns back up through 40 as price holds a level, right here. You enter on that turn, stop just below the pullback low, and target the prior high. You're not fading an extreme, you're buying the dip in momentum within an established uptrend, which is exactly what RSI is good for. Let me hammer the biggest mistake one final time, because it's that costly. Shorting a strong stock simply because RSI is high is the #1 account killer for newer traders. Strength persists. The tape can stay overbought far longer than your margin can survive. If you must trade against a trend, demand divergence plus a broken level first, never the bare overbought reading. And place it correctly. RSI is the momentum layer of the Confluence method. It confirms that force is behind a move, but it is not a standalone trigger. Its job is to agree with your structure, your level, and your entry candle. When momentum lines up with the other three signals, you have conviction. When it fights them, you stand aside. So, RSI measures momentum. The 70-30 levels aren't automatic signals. Divergence front runs reversals, and in a trend you never fade strength. You buy the momentum pullback instead. Use it as the momentum layer of your stack, never alone. Subscribe for the full method, and this is education, not financial advice.